Hello everybody and welcome to our channel. Today with us there is Prashant Singh and Sean Jutahkiti from Neuberger Berman. Prashant is a lead portfolio manager for Asian fixed income and Sean is a head of Asian credit research. Since the outbreak of the coronavirus pandemic, we have seen a lot of volatility in the markets. Can you explain especially developments in Asian fixed income market since January 2020?
Yeah, that's a very broad question. So I'll talk a little bit about the local markets in the region, and then Sean can add his own thoughts on how the Asian dollar bonds have performed over this period. So as the COVID-19 spread hit the Asian economies, we did observe initial weakness in Asian bonds. It was largely driven by a relatively large-scale outflow from EM fixed income across the world, and Asian bonds were not spared either. But since then, we have seen a reasonably strong bounce back in the regional bond markets. A lot of it has been driven by the very aggressive monetary easing that we have seen in the region. The central banks have directly supported the bond markets as well, and that has also been one of the pillars on which the recent strength has been built. We have also seen some concerns in the market because of a widening of fiscal deficits and the resultant higher supply that is coming through into the local markets. And that has resulted in, on the margin, most curves becoming steeper in the region. But by and large, the dominant theme has been the aggressive monetary easing in the region, and that has resulted in a fairly strong performance over the last several weeks in the local markets.
So in Asia credit, we have seen a downgrade in corporate ratings outlook and expectations, given the very sharp drop in the macro backdrop and corporate conditions. But in investment grade, we believe up to 2% of the investment grade index is at risk of falling to non-investment grade, compared to no expectations of downgrades prior to the COVID-19 shock. And as for high yield, our default expectations, we have increased it to 4% from 2% prior to the COVID-19 shock. So all this is a deterioration in outlook in credit fundamentals and ratings. But while these risks have increased, we think some improvements in credit fundamentals over the past few years have mitigated these current negative shocks. So we expect the current BBB plus rating of the Asia Credit Index to be maintained despite this overall deterioration.
How have bond yields and spreads developed for the various markets in Asia during the last couple of months?
As I mentioned, that bond markets have been performing reasonably well over the past several weeks. The rebound in performance was largely driven or largely led by the lower yielding markets first, markets which had healthier sovereign balance sheets, which were also less reliant on foreign funding or even foreign portfolio flows. So markets like South Korea, Thailand, China, even Malaysia to that extent, which have benefited from this monetary easing and less reliance on the foreign flows. The two relatively higher yielding dominant local markets in the region, which are India and Indonesia, so they came into this crisis on a slightly weaker foot. India had suffered from fiscal issues, so limited room available in terms of the fiscal support that could be provided, while Indonesia was too reliant on foreign financing, both from an external debt perspective as well as the portfolio flows into the onshore markets, which usually take up a large amount of supply of Indonesian bonds. But over time, even these two markets have started to play catch-up. We have seen India probably slightly ahead in the rally as a central bank provided very aggressive support in terms of bond buybacks. And over the last few trading sessions, we have also started to see Indonesia starting to play catch-up as the supply concerns are no longer as punitive as they used to be earlier. So in general, overall, we have now started to see a catch-up from the high yielders too. And broadly, the entire space seems to be performing fairly well right now.
Yeah, so in the dollar credit spread space, spreads have retraced the recent wides, but are still over 100 basis points, 130 basis points wider than at the start of the year. At the beginning, I think it is similar to the local bond space. China has performed well given their higher savings rate, and that has resulted in more domestic bid for their bonds. As for Indonesia and India, played catch up in recent weeks. But they still lag China overall. And I think more importantly, across Asia credit, the ratings play a more important role. So the lower rated credit segments have widened out much more and remain laggards, while the higher rated segments have performed much better. But across the credit spectrum, we do think that the spread widening is overdone. In the investment grade space, current spreads are implying close to a quarter of the index becoming fallen angels or becoming from investment grade to high yield, while we actually expect only no more than 2% of the index to be really at risk of becoming fallen angels from investment grade to high yield. And as for high yield, we also think the spread widening has been overdone. Current spreads are implying something like 11% default rates versus our expectations, as said earlier, of 4% default rate.
How have bond yields and spreads developed for different Asian countries since the outbreak of the coronavirus?
Once the COVID-19 crisis started spreading, the liquidity was significantly impacted across the region. Some of it was simply down to the uncertainty regarding the economic impact of the crisis, but there was also an element of risk takers simply not being able to participate in the market because everyone was adjusting to the new working from home environment. And there were some challenges on that front as well. Now, once that initial phase has passed, it is good to see that we have seen a rapid improvement in the market liquidity, and at least certainly on the local market side, though you can say probably on the dollar market side, we are still having we still have some more room to improve. So on the local market side, I think it is quite encouraging to see that we are so close to almost normal levels now. It's a clear pointer that to not only the depth of the local markets, but also credit to the technological improvements which have allowed the market liquidity to come back and normalize this quickly.
Why is the local Chinese bond market decouple itself from other bond markets?
First point, I'm not so sure if it is still fair to say that the Chinese bond markets have entirely decoupled, especially over the past few weeks. It is true that their correlations over a broader or longer horizon to other markets or even other asset classes is lower, but we still see a reasonably similar behavior the past several weeks. Now, coming to the lower correlations that we have seen over past, let's say, a few years. The primary reason clearly is that the foreign participation in Chinese bonds has been quite low and has only recently started to pick up. The primary driver of Chinese bonds clearly as a result of lower foreign participation have been the local factors, which explains the lower correlation that Chinese bonds have had to external asset classes. This will likely change over a period of time as now Chinese bond markets have started to open up more to foreign investors. The Chinese bonds are now getting included in various global indices, and we have been witnessing strong portfolio flows going into the Chinese bonds over the last several months now. So I believe while the domestic factors will still be the dominant force over the foreseeable future, but the correlations will probably on the margin increase as we go forward. The other thing is, even in terms of the COVID-19 spread itself, it is clear that China was the first economy which truly felt the impact of the crisis, but then they have also handled it relatively well. They enforced some of the strictest lockdown measures that we saw across the globe. And hence they are looking at a different set of factors which are driving their own policy actions at this point of time. And this difference in policy actions on the margin might also result in different performance of the Chinese bonds over the next few months.
How has the structure of your Asian bond portfolios been changed in terms of maturity and quality since the outbreak of the coronavirus?
When it comes to credit quality in terms of ratings, we really haven't seen that much of a change at least in the sovereign space. So we have seen a couple of rating downgrades, but this has happened only in the frontier space. So we have had Sri Lanka and Papua New Guinea, which have been downgraded. We have had a ratings outlook of Pakistan and Mongolia that have been changed to negative outlooks. But these markets have relatively small weights in the broader portfolio, even in the broader index, and does not materially change the rating profile of the portfolio or the index as well. Amongst the mainstream markets, we see potential concerns around rating actions in India and Indonesia. But as our base case, we do not see a negative rating action at least till the middle of next year. And a lot of it will depend on how the economic data evolves in these two countries over that period of time. In terms of our own holdings, we clearly like duration in the region. We have been increasing our duration positions. We believe that the monetary stimulus that has been provided, that will stay in place for a fairly long time there, and that will keep supporting the bonds. The liquidity conditions remain very supportive of fixed income, and we like to own duration. Even the supply concerns which are there on the margin, we believe that the authorities will provide support to the bond markets and should not result in any significant uptick in yields in the markets over the foreseeable future.
So we have seen this incredible growth for the Asian fixed income market since the Asian financial crisis in the late 1990s. So how will this growth story go on, and what long-term effects will the coronavirus pandemic have on Asian fixed income market?
What the crisis has done is to demonstrate the ability of the Asian policymakers to use a wide variety of tools and calm the markets down in a relatively short span of time. I think that has been very heartening to see from an investor's perspective. What this would do, this would give more confidence to the investors, and this would encourage more developments in the local bond markets or in the broader Asian fixed income market space itself. Now, obviously, one big challenge that we will face would come at a time when some of these extraordinary steps or the facilities that have been put in place, these have to be unwound. That may once again test the markets at that point of time. But if history is any guide, then I would expect the markets to come through that phase in a fairly decent shape as well.
From a investor in corporate bonds, as well as from a perspective in analyzing corporates, I think with Asia close to half a year into the pandemic, this has been a real stress test on funding for corporates, as well as how corporates cope with the stress. And I think it's good to see that they have coped quite well with funding to banks and corporates remaining open despite this large shock. So going forward, I think investors will be more confident on the corporate bonds they invest in, and corporates will be more confident in the markets and as well as the funding access that they have.
This have been Prashant Singh and Sean Jutahkiti from Neuberger Berman. Thank you very much, gentlemen, for being here with us today and sharing your insights.